Hello everyone, welcome to Blue Dragon Universe. This is the Blue Dragon Actuarial YouTube channel, and today we are going to cover this topic called Invest Single Premium Policies. So we have already covered the part one of this, where we defined the Invest, and then there are a couple of questions that I've asked. Today is the video that I'm going to answer that question, which is related to the single premium policies. Now in the comment section, I think two people has answered. Out of that, I think Saurabh Khatan, as always, has given the best possible answer. My team has shared the screenshot with me, and it's amazing. Now, talking about my team, there is also one controversy that is going on in our LinkedIn page, and I'd like to address that. But at the end of this video. So first, let us concentrate on the learning the topic without any drama, and then we can kind of also consider that controversy, because I believe that if that is also very important, if one side of the story is revealed, and also kind of you also need to know that if you are purchasing a course, because at the end of the day we want you to spend your money to purchase our course, right? So if you are doing that, you need to know that you are in good hands, right? You are not purchasing a course from someone who is mad crazy and has a habit of creating a controversy, right? So that is something that I think that is important. So but before we get to that part, let us continue with this, right? So NB trend for new business policies. Now, does NB trend exist for single premium policies? This is the question that today we are going to understand this. Now if you kind of remember this, the answer is yes, right? This is the short answer. Yes, NB trend exists for new business single premium policies as well. But let us go deeper into that. Now, obviously, I think you remember the Investon formula, that is reserve at t equal to zero. That is, once again, that is t equal to zero plus. There is no reserve at t equal to zero because the policy is not enforced, but t equal to zero plus, right? So it is a reserve at t equal to zero plus initial expense minus the premium at t equal to zero. Now, for single premium policies, that is the only premium you are going to pay, right? There is no further premium payment required. So that is the only premium that you are going to pay. So reserve at t equal to zero plus initial expense minus the premium at t equal to zero. That is your NB strain, right? Now in IFRS 17, because of, or wherever whichever regime uses best estimate reserve, that is this reserve has turned negative. So that means that overall your NB strain formula is usually negative. So there is no NB strain, there is NB gain, right? Instead of strain, there is gain, and that happens in Solvency 2 IFRS 17 because we have moved into kind of best estimate basis. Now, this reserve, when we are talking about reserve at t equal to zero, this is on prudent basis, and that is why there is NB strain, right? And there is another way you can have NB strain even in best estimate basis when the policy is written on loss making basis. The only reason I can think of policy being written on loss making basis is when the insurer is trying to capture the market. Otherwise, there is no such reason. Now, if you have been part of our IFRS 17 live workshop, then you already know this. Now we did our first IFRS 17 live workshop. There were 6 people that kind of registered, out of which one was not able to attend. So actually, I did it with 5 people. And soon after, there are a couple of messages and emails like, if we are doing that, doing the IFRS 17. So right now we are not doing that because the September exam of IFA is very near. So if we have to do that, we'll do that somewhere in October, right, or end of September after the IFA exams are over. And if you want, you can still purchase the course. Once again, there is no discount. You will get the recorded videos and also the Excel formulas. I have released one video, uh, sample video, like to make you understand the depth in which we cover the IFRS 17. So you can go through that. That's a big video, 1 hour 30 minutes video. And if you understand, if you feel that you can gain something from that, you can do that. But if you want to wait for the live workshop, then it can happen in September, October. I do not have any fixed date on that, right? Because it will be a 5 days continuous live workshop where I have to, kind of, I have to make myself free to kind of deliver that. So that will take time, and also you guys need to be free as well from the exam pressure, right? So right now there is no point in doing it, as I have understood from you people that you still guys, you most of you kind of prefer the exam, although exams are this time also IA has increased the passing rate, which means exams are getting lower importance now. Like very soon we'll have many people qualifying very, very quickly. It's not because they are good, it's because that the institute are pushing the passing rate, and that is how it should be, I believe. especially for SA2, SA3. This time I saw SA2 has 24% passing rate. And for the last decade, when I was appearing for the SA2 paper, it just have 5%, 6%, not even once it covered 10% or it went over 10%. So you can check that. Like if you do not want to believe that, you can check that. And this time it came out to be 24%. Last time also there was good passing percentage in all the essay papers. And there are a couple of papers I saw the passing percentage is 80%, right? Some paper I think 48%, 72%. So I mean these are very big numbers for II at least, right? And that is the way IIS has to proceed, because they otherwise they are going to lose revenue to IFOA, right? And they have also decided to give exemptions. So from revenue perspective, that is a good move by II. Will gain by from that, right? How much the student will gain, that's a separate thing altogether. But anyways, I think that the II will gain, and that is important for II as well, right? Because whatever we say, at the end of the day, II is the body that is doing all those webinars and everything for us, right? These days I've seen that they're also reaching out to colleges and schools to promote the actual profession, right? So that is also commendable. That is also good. I initially had the thought process of doing that, but someone stole our thought process. Anyways, so the this is the formula for new business train. I hope that is clear. It's just to make it kind of uh, uniform. I have used the t equal to 0. Just remember that that is not t equal to 0. It is t equal to 0 plus, but t equal to 0 can also be used interchangeably, right? So, however, here the premium is single and big. That is the that is the basis of single premium. So all the premiums should be captured in that single premium, right? So what changes for single premium policies? The time zero reserve reduces significantly, because the remember the formula, expected present value of benefit plus expense minus premium. In this case, the premium is huge, right? So that is why the time zero reserve reduces significantly. It can even go negative, right? Although it is not best estimate, it will not usually go negative because it is prudent, but it will be very, very small. The initial expense, would not change that much, right? So in that case, the premium can be so significant, right? Because, and obviously we have already discussed this, the reserve is reduces because of the higher premium at t equal to 0, right? And that is why usually strain may not exist in single premium policy as well. It can also be a gain, right? Instead of strain, it can also be a new business gain. However, if the premiums at t equal to 0 is not big enough, right? And we'll see an example maybe where this can be happening, right? If the premium at t equal to 0 is not big enough, then it may be lower than the initial expense and reserve, the sum of these two, initial expense and reserve. And in that case, the strain usually exists, right? And it is possible for pure protection policies like term policies, critical illness for health insurance product, even if you are collecting single premium, right? Although in their case, the reserve is also very, very small, but both being small, the decrease in reserve might not be sufficient to offset, the new business trend. There might be still some new business trend left. So once again, it depends on the formula, right? Usually for single premium policy, there might not be new business trend because the reserve reduces. The initial expense is not that, no, it's not changing that much, just because of premium or renewal, initial expense do not depend on that. So initial expense would usually be the same. So the reserve reduces and also the premium increases. So the negative thing increases, the positive thing decreases. That means the negative things takes over, right? So you can visualize that. But if the negative decrease in the negative thing is, or if the increase in the negative thing in this case, and the decrease in the positive thing is not in sync, or the decrease in the positive thing is not as much as compared to the increase in the negative thing, then this can, there can be strain, right? And usually that happens, right? For pure protection policy, also for by pure protection, the reverse of pure protection is also like annuity product. There can be new business strain, right? And annuity products usually a single premium product only. So because in that case the reserve is huge, right? The reserve in for an annuity product, the reserve would be huge because of all the annuities at t equal to 0, right? Because you are not going to consider the premium there, right? And that's why there can be strain as well, right? So it depends on the formula, right? It depends on the formula. I have also seen companies who are not using, that for single premium policies, they're not considering the premium at t equal to 0, right? Obviously, at t equal to 1, there would be no premium, right? So it will be just the expected present value of benefit plus expense. But just to be in sync with that approach, they at t equal to 0 also, where they should consider the premium, they are also not considering the premium there. So for that sort of policies, once again, that's a prudent approach. And for that sort of policy also, the new business strain would exist because the premium is not kind of reducing the, because the premium is not captured at all, right? So in that case, it depends on the company approach, right? Some companies have seen the premium is captured in the calculation of the T0 reserve, but when they are calculating the new business strain, the premium is not captured. So it is just the reserve at T equal to 0 plus initial expense. Once again, in that, in methodology as well, the new business strain exists, right? So if you are asked this question in an interview, whether new business strain exists for a single premium policy, your answer should be depends, right? And how it depends, that you have to explain using this formula, right? Whatever approach that company has followed, depending on that approach, the new business strain can exist or may not exist. If it is a best estimate, chances are new business strain do not exist. It is new business gain, which happens in IFRS 17 Solvency 2. However, if it is not best estimate, if it is prudent, chances are that it will exist. And if you are asked to give an example, maybe pure protection policies, right? And the reverse of pure protection as well. So I'm considering annuity as a pure protection as well, because it is protecting you against the longevity risk, right? So that is why I'm not given the explicit name of term or kind of critical illness. So you can, I think the best example in this case would be annuity, right? And finally, so NB can also exist for new business single premium policies, right? So I hope this is clear. Now let us come back to the the controversy that has happened, and for that I need to go to my LinkedIn page. So that's it. I hope you get clearer on that. There are a couple of beautiful courses that we are planning, and you are going to see that, right? And also, if you have not registered for CP3, CP2 till now, those are the papers that you can do in 1 month or 1.5 months. Our you can just go to the description section and you can visit the actual courses, right? We can even do trading related courses. So all those are present in our, kind of website. SP2, SA2, we have started the live mentoring of SA2 for the India one. That registration is open, but for IFO UK, we have closed that, right? SP1 is the new paper that we have added. So all those papers have been added. There are 5 or 6 papers, I believe, and we are going to add the lower papers from December, right? So stay tuned for that. Stay tuned for the knowledge related to the free knowledge that is available in our YouTube channel. And yeah, hopefully we'll meet soon and maybe also work soon, right? So see you in future videos. Please hit like, share, subscribe, and yeah, that's it. I hope you had a good actual career and actual journey.